Hi, everybody. Welcome to today's virtual personal finance series in partnership with the NOLA Libraries Summer Fun program. This is running every Wednesday at 2 p.m. Until the end of July. If you'd like more information about upcoming webinars, please visit www.flightcoaching.com/summer fun, or have a look at the NOLA Libraries website. My name is Alexander Bigby. I am the Executive Director of Flight. We're a New Orleans-based nonprofit that helps create free and high-quality financial education resources for communities in and around the New Orleans area. If you want to learn more about us, please check out our website. I'll put it in the chat box. Please also have a look on Facebook and like us if you'd like to learn more about upcoming events. Today's format will be a presentation, probably should last around 25 to 35 minutes, and then there'll be a Q&A afterwards. If you have any questions at all during the presentation, please write it in the comments box, or at the end you can unmute your microphones and ask it in person. The presentation from today and the recording from today will be available on our website, which is the Summer Fun part of our website. I'll put all of that in the chat box so you can copy that down later. That will be available within 24 hours of this presentation. So without further ado, I'm going to introduce today's speaker, who is now a regular with Flight, Tracey Textor from Home Bank. Thanks for coming and joining us again. This is, I think, the third time you've done this.
Yes, it is.
Yes, it is, and I'm excited even this time. I really enjoy this presentation. I feel like I learn something every time from it.
Well, thank you. That's what our goal is.
Excellent. So yeah, I'll let you take it from here, and yeah, thanks again for hosting the session today.
Oops, I'm sorry.
Yeah, I'll let you take it from here, and just a huge thanks from me for running the session.
All righty. Are you gonna you want me to share mine?
Yeah. Can you share your screen? Let me just check.
Right now it's saying host disabled attendee.
Okay. Let me quickly change the settings.
All right.
Hold on 1 second. What I'll do is I will make you the host.
Okay.
So you are now the host.
All right. Very well. All righty. While we're getting this set, I just want to thank everybody for participating this afternoon. I appreciate y'all taking the time and to learn a little more about starting your journey to becoming a homeowner. All righty. So as Alex said, my name is Tracey Textor. I have been a community loan officer for 25 years now. That's pretty scary saying I'm only 30, right? But, and so I really enjoy being a part of this journey with everyone. And I'm gonna tell you now, it won't be the easiest thing you'll do, but it will be the most rewarding. So to begin, you're taking the first step right now. How to get started, educate yourself. You're taking the time right now to be a part of this conference call, to learn the steps, and to really kind of get an idea of what to expect. While some of the things when you're educating yourself is going to be understanding your credit score, learning how to budget, maybe budget prior to, and then lastly, understanding the mortgage process itself. Now, as I said, education. You started today. This is your first step. You can attend home buyer seminars, either Zoom as this, or a lot of times we'll have face-to-face ones if we were not in the COVID era right now. You want to find a lender that's right for you. And when I say that, that's very important because you may work with a lender, they may be very popular, they may be one of the top producers, but that doesn't make that person right for you. When I say look for a lender that's right for you, you want someone that you feel comfortable with, that you are not afraid to ask any question to, that when you're going through the process, if you pick up the phone on a Saturday and you're really nervous about something, you're not afraid to call that person because they will answer and they will put your fears at ease. Generally, if you're a first-time home buyer, you're going to have to participate in a reputable home buyer counseling program. And when I say reputable, it's not that one is necessarily awesome and the other is not, but a lot of grant funds that you may qualify for have certain requirements. So it may have to be an FHA approved counseling program for you to participate in. But when you're working with a lender, we will give you a list and help you reach out to the right counseling session that you would need to participate in. Some of the sessions may be 8-week programs. It's an hour a week and it's face-to-face. Or if you're more comfortable, there are programs that are online that take about 3 to 4 hours online, but you can do it online so that you can do it at your convenience, whether it's at nighttime or on the weekend. Maybe you go to school, maybe you work a job that you work different shifts. So maybe an online class might be better fit for you. So there's different programs that will help you reach out to the right one for you. And then lastly is contact your real estate agent. And again, finding a real estate agent that fits you. Somebody maybe that is gonna take the time. Go house after house with you if need be. Go to different areas to help you find what's best and what you're really looking for in your first home. Understand your credit score. This is really very, very important because a lot of times you may think your credit score is horrible, and guess what? There's still programs for you. But the first step is for you to see what your credit report looks like. You can go to www.annualcreditreport.com. Again, if you have a pencil and paper, write that down. www.annualcreditreport.com. Normally, you can go to this site once per year, and there's 3 credit reports, and pull each credit report 1 time per year. But right now, due to COVID, for the next year, they're allowing you to pull these monthly. Now, when you pull them, it's going to show you everything that is in your report. There's going to be items that are 20 years old. And there may be items that are only 2 months old, but you want to understand what's in it. Because when you're looking at your credit report, you are assigned a credit score. And the score is what helps you purchase homes, cars, get credit cards, and get, a better interest rate in some instances or a higher credit line. If you look at the little graph to the side, this shows you what comprises the credit score. The first is your payment history. 35% of the score is your payment history. That is why one thing I will always tell you, always make a payment and make it on time. Even if you're in a situation like these days that you cannot make a full payment, make some sort of payment. Because they're not necessarily reporting that how much you paid, but they're reporting that you made the effort to make a payment. So please, no matter what the situation is, make some sort of payment on everything when it's due. The next big chunk is the amount of debt you have. So 35 is payment history, 30 is the amount of debt. Again, what they're looking for here, you may have several cards or you may have 2 car loans, but what they're looking for is they don't want to see you maxed out every month. If you have 3 credit cards and with a $3,000 balance on each one and you have no available credit, that is going to hurt you even if you're making your payments on time. The idea is for you to really have credit available is what they're looking for. Next is length of credit history. Again, the longer you have something, the higher score you're going to have. It is not looked at favorably if you have 4 new credit cards in 1 year. They want to see you get a credit card and keep it, because what they're looking for again is that track record. They want you to have a piece of credit for a long period of time. Don't use all of it, even if they offer it to you, and make sure that your payment history is paid on time. The next is new credit. Again, the length of credit history and new credit really kind of work together. The whole point is to have it as long as possible. That's why I always share with people, if you're going to pay a credit card off because you're getting ready to make a purchase, do not close it. Believe it or not, if you close it, it will hurt your score. So it's better to have something with no balance and still open than close it and not have it available to you. And lastly, they're looking for a credit mix. When you're building your credit score up, they don't want to see you just have 4 credit cards or 4 store credit cards. Maybe they want you to have a car and maybe a credit card to Old Navy, a credit card to Walmart, but then have like a MasterCard or a Visa. But there's different types of credit that you can have, and they want to see a variety. They don't want to see just one type of credit only. How to get a better score. Keep these 5 points in mind. Now, when you're trying to build your credit, there's different things you can do. Maybe you have no credit right now, and to start off, you may need to start with a secured credit card. You can get those. When you get a secured credit card, you put X amount of dollars into that account, almost like a savings account per se, and they give you a credit card to use. But they report it to the credit bureaus as if there was nothing there to secure it. That is a great way to start your credit. When you're rebuilding credit, same thing, a great way to do it, because the lender is not taking any risk, but it's helping you in the meantime to build your credit up. Credit reports are agencies that all input information to give us your credit report. Generally, when you're looking at a house, we pull what's called a tri-merged credit report. And what that means is the 3 main credit bureaus are Experian, Equifax, and TransUnion. But just like in school, you may have 3 different teachers and they all grade slightly different. These 3 credit reporting agencies also grade a little bit different. So when you're trying to purchase a home, we pull a tri-merge, so we're gathering information from all 3 of these agencies, and we're going to use your middle score. So if you have a credit score of, say, 590, 610, and 630, we're going to use the 610. But that's to keep it fair, because we know sometimes one agency might grade really hard on something and another one might be a lot looser. So we're going to pull all 3 and take your your middle score. And then again, just to give you an idea, when you're looking for homes, when you're looking to get pre-approved, generally right now, 600 scores and above is what a lender is looking for. Now, again, we're in extraordinary circumstances. Some of the lenders are a little bit tighter, but in normal environment, a 600 credit score and above can get you a home loan. Common causes for a low credit score. Collections. Typically, when you haven't paid a bill, Typically, when you haven't paid a bill for 90 days, at that point, your creditor usually sends it over to a collection agency to try and attempt to collect the debt. Collections are going to give you a hit on your credit score. Judgments. Judgments are the next step into a deeper situation. If it's a large enough collection account, that lender or whoever you owe those funds to will go to a judgment. A judgment is going to follow you. A judgment goes to court and files that you owe them the money, and it is in your credit report. Collections and judgments are in your credit report. From a judgment, it goes to a lien. A lien is also within the court system, but that is the one that can ultimately stop you from purchasing a home. The judgments depend on how much they are. Generally, if collections or judgments are under $2,000, you are not required to pay those back prior to purchasing your home. Over $2,000, yes, you will have to pay to bring it down or to pay it off completely if it's one account. Liens always have to be paid off. Student loans. Student loans, it's not necessarily that they are a bad thing, but we like you to understand that as great as they are, we don't want you to take advantage of them. A lot of times people think of student loans almost as free money, because especially when we're young, you may take out a student loan. You might have, especially with TOPS these days, your schooling might be paid for, but you can get this money. You don't have to pay it back right now when you go buy a car. Well, the problem is going to come in 5, 6, 7 years later when you're ready to purchase a home. When you have a student loan, we know the government is going to get their money some point in time. Okay, it's never going to go away. So because of that, even though that loan may be deferred, we are required to count a monthly payment into your debt to income ratio. When we do that, sometimes it can push your ratios above what is allowed, and it can prevent you from purchasing a home. That's really frustrating when you're looking at me and telling me, but I'm not even required to pay it back yet. We understand that and we feel for you, but we know the federal government is never going to let that loan go. So it does always have to be calculated whether you're paying it back right now or if it's deferred. The next step in getting ready is budgeting. Now, when I go through this, the reason why budgeting is important is because when you come to me for me to qualify you, all I'm going to see on paper is black and white. I'm going to see what your minimum payment is on your credit cards. You're going to tell me what your rent is if you pay rent, and I'm going to see exactly how much money you make. So sometimes on paper, I may approve you for more than what you truly feel comfortable with. And that's why you making a budget is the most important, because you're going to be able to tell me what your lifestyle is. So when you're looking at a budget, you're going to look at what your total income is, and then your expenses. Now, on this graph, honestly, it may not be realistic for you. Okay, but it's supposed to get you thinking. Mortgages. Generally, your house note, it really starts getting harder for you when your house note is more than 20 to 25% of your total income, because then you're really giving yourself very little leeway for anything else. Utilities, you figure about 9%, medical and health, 5%, transportation, 15%. Well, in that 15%, you should be figuring if you have a car note, your car insurance, and how much gas you use each month. Credit cards or loans. You generally would try to keep that at 11% of your income. Food, 5%. I don't know about y'all. I know that's difficult for me. I have a family at home. Children, 8%. I personally think that's, very reserved. I know my kids cost me a lot more than 8%. And then savings is 25%. And this is where I say it's hard for me to tell you what you can do, and I rely on you to tell me. I don't ever want you to be married to a house. And when I say that, I don't want you not being able to do anything because you have a house note. If you like going out to dinner, you know, every Friday night, you have to count on how much you want to save for that or to be able to continue to do that. If you like going on vacation, you have to take these things into consideration because I don't know your lifestyle. Some people are very frugal and they can look at that and say, I can cut that down even more and save more than 25%. That's great. But I'm going to count on you to let me help you figure out what's best and, you know, what can still allow you to have a life and own your own home. Understanding the mortgage process. So once we've gone through and we work on your budgeting and we work on getting you pre-approved, this is to kind of help guide you and help you understand what exactly is going to happen. So what is a mortgage? A mortgage is actually a lien on a property that you are promising to repay that loan. The mortgage is held by the lender. It gives us the right to collect payments on the loan. And if you don't make payments, the right to foreclose. A mortgage application, I'm really just gathering the information from you. And it's the major points. I want your full name, your address, date of birth, social security, and your income information. So when we get together, my list is probably shorter than what you think. I'm looking for W-2s, I'm looking for tax returns, 30 days of pay stubs, and 2 months of bank statements. And that's it. That's all I need to truly qualify you for a home loan. Oh, there we go there. Sorry, I didn't move fast enough. When you're looking at this though, it says purchase agreement. I don't need a purchase agreement to qualify you. The purchase agreement is going to be something that's really after we've done all of this and you know what you can afford. So the process itself, as I started out with, it is going to be very strenuous. It's very stressful. But I promise you, when we make it to the end, it is going to be one of the best feelings in the world. So just to give you an idea, so we have our initial application. And when you come in, that's what we're going to do. An initial application, we're going to look at different loan programs. We're going to get you a pre-approval. At this point, I can also let you know of any programs that are out there that you may qualify for. There's several different grant programs, down payment assistance programs. One of the ones I use a lot is called the Help Funds. That's for a first-time home buyer. And if we're at the 80% median income, then you could qualify for $10,000 towards your home purchase. So once we have your pre-approval, you'll start looking for a property. When you find your property, I'm going to lock your interest rate in. These days, interest rates are great. Interest rates are generally running between 3 and 4%. A lot of times I tell people in the environment we're in right now, you may never refinance your house again because there may not be a time again that interest rates will reach this low. At that point, we're going to do income and asset verifications. And what that means is we do have to contact your employer, confirm how much money you make. If you're hourly, we ask how many hours you work, just to verify that we have the true amount that you are taking home. The appraisal and title request, and then once we have everything, we submit it to underwriting. When that file goes to underwriting, I'm going to submit everything you've given me, but generally, I'm going to come back and ask you for something else. When we submit everything, that's the basics. And then the underwriter may come back. You may have an unexplained one time, maybe you sold a car and you deposited $5,000 in the account. Well, probably they're going to ask for a letter of explanation where that $5,000 come from. So It'll go back and forth a little bit like that. Then they'll clear everything. At that point, we're going to get your homeowner's insurance. And then I'm going to tell you, guess what? You're clear to close. Let's schedule your closing. That would be 4 days from the day that I get the clear to close. Mortgage loan products at Home Bank, pretty much any loan program that you can imagine, we work with. We do FHA loans, we do rural development loans, and conventional. FHA and conventional loans, you're generally putting 3 to 3.5% down. I know a lot of people out there are still thinking you need 10, 15, 20% down. That is not true. Generally, you're at a 3 or a 3.5% down payment. If you do a rural development loan, that is a 100% loan, but that is a loan that is limited to specific areas. Orleans Parish does not have any rural development. Jefferson Parish does have some on the West Bank. St. Bernard, St. Tammany, and St. Charles Parish, all 3 parishes are rural development areas. A VA loan is for someone that did serve in the military. Community reinvestment mortgage, this is programs that we at Home Bank offer, and it is a loan for someone that is just starting out, maybe doesn't have any funds, maybe doesn't even have traditional credit, but it's a loan that we do, it's in-house, and it's to help start you out. Adjustable rate, ARMs. It's not something that, you know, I generally recommend to someone that's a first-time home buyer, but if you know that maybe you're in the service and you're gonna move in 5 years, but you really wanna buy a home now, then that's understandable, but it's not something that I would recommend for you to do on a first-time home. That would be a long-term purchase. And then there's construction loans and renovation loans. So we do offer an array of products. Generally, we can find something that would be a good fit for you. When you're looking at homes, there's different property types. There's a single family detached. Generally, that is a regular home that you're going to look at. Detached means everybody has their own individual lots. A single family attached is, for instance, townhouses. You do own your individual home, but there might be 4 of them in a row. Planned unit developments, that is just neighborhoods that have homeowners associations. And then there's condominiums, manufactured homes, which is mobile homes, and unimproved property, which is vacant land. The one thing I like to share when going over this slide, though, is condominiums. Sometimes people look at condominiums because of the fact they say, oh, wow, look at this. I can buy a condominium completely redone for $140,000. And that is great, except for condominiums have monthly dues. Generally, dues on associations right now between $300 and $500 a month. When you're looking at a house note that might be $800, but then you add $500 dues, you're now at $1,200 a month. So not necessarily is a condominium a great idea because of the fact in the long run, a lot of the times you are paying more than if you would have just purchased a single family home. Down payment assistance, as I had touched on a little while ago, we have several programs that we do. HELP is my favorite one, just because it's the most money and it's the easiest to get approved for. Louisiana Housing Corporation has programs, and then there's different programs for different parishes. Orleans Parish actually has what's called a forgivable grant. Depending on the area you're purchasing in, you can have a grant up to $30,000. Jefferson Parish has down payment assistance programs that can be up to 10%. All of these programs are going to be income-based in majority of the cases, but they are easier to qualify for than you would really think. And I'll usually ask everyone to please allow me to look to see if there's anything, because 9 out of 10 times I can find something that you could qualify for. And that's it. Does anybody have any questions this evening?
Thanks very much for that talk, Tracy. It was always great to hear your knowledge and experience, and thanks for
Yeah.
giving up your time for it. I'll get the questions kicked off. I'm sure there are other people who. So, so are you, if you're, you have a good credit score, but you maybe have some income issues, you're self-employed and you don't have regular income, and you maybe haven't had a particularly good amount of income coming in recently, are you able to get an individual from another bank to help guarantee a mortgage? Does that help?
Okay. First, when you're self-employed, it's good and bad. Self-employed, we are going to actually average 2 years worth of income. So in the environment we're in right now, you may be a little off the last couple of months, but we do average 2 years. And yes, if you do want to purchase a home, it's something you can't pass up and you don't qualify with enough income, you can have a co-borrower or a co-signer. The downside to that, though, is you're also taking on that co-signer's debt. So you really have to kind of be a little picky on who you ask to be a co-signer. You want someone that has the income but doesn't have a lot of debt, because if they have high debt income ratios, then that's not going to be the person that would be able to help you. Okay.
Okay. That's great. And another question from me, what kind of differences do you get between, if you're applying for a loan through, say, a smaller, more local bank like Home Bank versus a national bank like Chase or a credit union? Are there differences?
Yes. The main difference when you're going between a large bank versus a local bank or even a local credit union. The local banks and local credit unions are very comparable. When you're going with a larger bank, the problem is they don't have local underwriters. And so not all the time will they be able to understand, the different instances that are going on here. So I prefer, whether you work with me or not, I prefer you always give your local lenders an opportunity first and then see. Because the same thing, I have someone, prime example, I couldn't help them. I told them I needed them to wait a little bit longer. They went to Quicken Loans, and Quicken Loans did the loan, but the fees were enormous for them to do it. So that's why I always say, look at your local lenders first, and then if it's, something that can't work out, there are other opportunities, but usually those are the more costly ones.
Okay, that's great. Thank you very much. I have a couple of written questions here.
Okay.
Do you have any recommendations if you're purchasing a house with your spouse, and one of you has excellent credit and the other one does not? That's a great question. We definitely get that one a couple.
That is a great question. So when you're purchasing with your spouse, it's actually going to go on the lowest middle score. So let's say he has 600, 650, 700, and you have 620, 645, and 680. It's going to go off the lowest one, the lowest mid score. So if it's about 680 and above, everybody's going to qualify for the same. If the mid score for one of you is lower than that, you might take a little hit, but it's not going to be enormous. And so it may not necessarily make a big difference. It's only if somebody's going to disqualify you that it would really be an issue. And when I say that, the credit score is the main thing. But honestly, on the other side, let's say it's a husband and wife and it's a second marriage for one of them, and they have to pay child support or alimony. That may hurt your debt to income ratio, so that person may need to stay off of it for you to qualify. So there is different scenarios, but don't necessarily think just because one is a little lower than the other that you have to remove them. Look at it both ways first, and then work with your lender and let us tell you, you know, which way would be best for you.
Great. Just to let everyone know, we are running Flight along with Fund 17. We're actually running a deep dive on credit tomorrow at 11 a.m. We touched pretty well on credit during this presentation, but tomorrow at 11 a.m. we'll be doing an hour just focused purely on credit scores and improving credit scores, reading credit scores, everything. I put the link at the very top of the chat to the sign up. So if you're interested in really getting a full deep dive in the credit score area, please click on that link and sign up. We have a great speaker from Hope Credit Union doing it. Another question here: what other research should be your next step?
So once you've done, participated in this, I would say your next step is to go to that annualcreditreport.com, pull your credit, and really get a good idea of what's out there and if there's anything you need to clean up. That would definitely be your first step in moving forward.
Agreed. For anyone who showed up a little late, everything will be available on our website and recorded, and so will Tracey's presentation from today within 24 hours. The link is at the top of the chat box. Does anyone have any questions they would like to ask by unmuting their microphones? I guess that's it for questions today. A huge thank you, Tracey, for coming in.
Not a problem. And thank you, everyone, for taking the time. As I said, if you have any questions, that's my office line or my email address. You can reach out, and I'd be happy to answer any questions you may have specific to your scenario.
Great. Thanks, everyone, for joining, and enjoy the rest of y'all's week.
Thank you. Y'all stay dry. Bye-bye.
Take care, everybody. Bye.